Okay, so let's look at this example. On August 9th, your company determines that it will not be able to collect $200 from this customer. Um, this is the direct write-off. Okay, this is direct write-off. So we're only going to do something at this time where we're like Dan King is not going to pay us. Okay, we know specifically which account receivable we're not going to collect and when. Okay, Dan King called us up and he's like, I'm going out of business or whatever. So at that time, we know exactly who is paying us, who is not going to pay us, and what the amount is. Okay, so now we can directly write it off. So what we do is we'll take a bad debt expense of $200 and we'll reduce this guy's account receivable because before we had account receivable King, we were sitting happy thinking we're going to collect $200 from this guy. We had an asset worth $200, but now this guy calls us up and we're like, we're not going to collect it. So this asset needs to go away. It needs to go to zero. So we need to credit this 200. And it's not like he's paying us the cash. Remember, if he paid us the cash, we would do debit cash 200, credit account receivable. But he's not paying us. So instead, we're going to take this bad debt expense. Direct write-off, why it's so simple? We know exactly how much and we know exactly who is not paying us so that we can directly go to our accounts and change them. Okay, we know exactly what to do. Okay. And again, even though we know on August 9th that we're writing this off, it could have been that this sale to King happened 2 years ago or whatever. It could have happened a long time ago in a different accounting period. So this expense is going to be mismatched with the revenue. Okay, so that's the whole problem with this direct write-off method. Okay, so I think we talked about this. What are the ways we could manipulate our financial statements? Again, a company could just generate a bunch of revenue by having some customer that is like is not credit worthy, right? You could argue, I don't know, these AI companies are doing this now. There's some rumors that like what's it called? OpenAI is going to go bankrupt. Okay, there's a ton of receivables that are probably outstanding where OpenAI is the one that owes money. Okay, so if they go bankrupt, all those receivables are going to go bad. Okay, so but in the interim, these businesses have booked a bunch of revenue off of OpenAI. I think a lot of the chip makers, Nvidia said OpenAI is going to buy $5 billion of chips, and they have a receivable for that. Okay, so they've already booked that revenue, and their stock has gone up accordingly. But if OpenAI goes out of business, that $5 billion of account receivable is going to go away, and they're going to have to take a loss for that. Okay, so this happens. Okay, this is not like a fake kind of hypothetical. This type of stuff does happen. Okay, now this is kind of like a special case scenario where let's say we wrote it off. We again did this write off. Our account for King looks like this. It's zero. But let's say he comes back and he's like, "Hey, actually, I can pay you. Okay, I found the money, whatever." So what we're gonna do is kind of first reverse what we did. Okay, so you can see here we're restating the account receivable. So we go from here. We're gonna debit this again, 200, and we're gonna credit this expense account. We're just undoing it essentially. Okay. Now there could be a problem in that this happens in a different accounting period than the expense, and we end up with a bad debt expense credit balance. So we'd have to fix that somehow. Um, Maybe make that other income. We'd have to make this actually bad debt revenue or something. We'd have to maybe fix it if it's in different accounting periods. Because remember, we can't have a credit balance in an expense. Okay, that would be kind of that'd be weird. We'd have to do something about that. But let's just assume that it's in the same accounting period. We're reinstating the account receivable. The bad debt used to be 200, right? From this, we had this debit, but now we're crediting it. So now we have zero bad debt expense. So we've kind of undid that entry, and now we just collect the cash. So now we get rid of this. So now this still goes to 0, but now we've debited cash. Okay, so this again is in the case where you first wrote off an account receivable, and then the person comes back to you and is like, no, I can pay you. This is what you have to do to kind of fix that.